Yeah, good morning, everyone. Thanks a lot again for joining us this morning for our client feedback session from PortfolioMetrix. As some of you might have noticed, it's not Craig Tor doing the introduction this morning. Unfortunately, could not make this session. Yeah, and he sends his apologies. Yeah, so I'm just standing in for him. Yeah, for those who haven't met me yet, most of you probably have. My name is Eric Rodon. I'm also one of the directors here at Crue Invest. Yeah, so just to start off things, thanks a lot everyone again for your time. We really appreciate it from our clients' perspective that you make the time to come and join us at these sessions and kind of come to listen a bit more about what our partners PortfolioMetrix have got in terms of their feedback from the investment perspective over the last couple of months, and also getting some more insight from them in terms of how things are looking into the future. So yeah, so again, thank you for all of you taking the time to join us. Also to PortfolioMetrix, thank you for your time to put together this session. We really do appreciate it, and our clients do really get a lot of value out of these sessions. So yeah, thank you very much for the time. Just from a housekeeping perspective, I seem like everyone is mute, but just in case you do drop off mute, just maybe keep an eye on that, because sometimes it does change, and we don't want some audio sometimes coming through that could disturb the speakers. So maybe everyone could just check on keeping things on mute. And then obviously, as always, we'd like to encourage people to ask questions as they come along, but maybe just keep them until the end of the presentation, and we'll have some time for asking of questions. Or if you don't want to ask questions today, we're always free to contact any one of the Crue team. Yes, and we're happy to engage with you on those questions. Yeah, so without much further ado, I'd like to hand over to Liam to take us through your presentation today. Thank you, Liam.
Thank you so much, Eric. And I appreciate both the introduction that you gave, but also the exposure that you give us through to your investors. I think it's very important that we sort of emphasize this relationship again. I see a couple of familiar names there in the participants list, which is good. I like to see that. But again, I think you'll know from previous sessions, there's a very close relationship between Crue and PortfolioMetrix. In both instances, we choose to partner with each other because we see value in the services that we can provide ultimately to you. I've shown a couple of slides in the past which show ultimately the idea of specialists or precision investment management, and then of course financial advice, which Crue takes care of, but in itself is a very large field. And I've very often spoken about the benefit of having a precision investment manager. We see value in it. I believe Crue sees value in it. And in fact, your portfolios have seen value in it as well. And I'm going to explore a little bit more of that now, just to show you some of the returns that we've provided. I'm going to talk a little bit more broadly about how we provided those returns. But just before I dive into that, I want to show you a couple of slides around what's happened over the last few months, both globally and in South Africa. So I'm going to share those slides now. Eric, can I ask you to just confirm, I've just shared them, if you can confirm that you can see them on your side, please.
I can see them on my slide. Thanks, Liam.
Perfect. So I'm going to start moving through these. To echo one last thing that Eric mentioned there, if you have a question, I believe you will have a Q&A area that you can type questions in. I know personally I like to ask the question in the moment because I typically forget it by the time I have a chance to ask. So feel free to type it, and then we'll then just address that near the end. And I assure you I'll leave a bit of time for questions. So please, I encourage you to use this opportunity where we can engage on it. I think it's an opportunity but equally for us to see what's on your mind, what you're thinking about, or perhaps where I've not communicated clearly. So something very simple, like a simple question. I'm very, very happy if you ask that. In a previous webinar, I was using the term alpha and didn't quite realize it. If it's something as simple as that you want clarity on, please ask. If you want some clarity on something far more complex, such as the result of the US election, please don't ask that, because I won't be able to help you there. But hopefully that becomes a little clearer as I go through. So let's talk quickly about markets. And I've emphasized here that it's a domestic affair. And that's important to say, because a lot of what drove returns in the last 3 or 4 months has actually been domestic South African things. So often we've been caught up in these global macro events, and if the US dollar is getting stronger, the natural reaction is that the rand is getting weaker. South African news headlines are focusing on the rand getting weaker. And it's easy for us to get negative about South Africa. Fortunately, we've got some very good news to talk about. But it's not always a South African or domestic affair that's driving our markets. Over the last couple of months, it really has been. So let's take a look at some of these returns. What I've got over here is calendar years. Of course, these returns on rands. Calendar years, so you can see 2019, 2020, 21. Let's just remember 2020 was COVID year, 2022, 23. And then, of course, 2024 to the end of June. And then each one of these colors represents a different asset class that we use to build the portfolios. So we know global equity has done well. Everybody's spoken about it. I don't believe people have spoken nearly enough about how disappointing SA equity has been, but it's not all doom and gloom. And I'll point out about how we or speak about how we've turned a corner. I want to emphasize 1 or 2 things here. So if I follow the blue dots here, that's very much global equity in its rankings, only having one bad year in 2022. And that was a year where SA Rand strengthened. We had the start of inflation. But what was important here is that SA bonds started to do quite well in what looked like quite a risky period. 2022 was a very risky period in and of itself, but that played out very differently, of course, through COVID and the type of stimulus the market had. But if you take a look at the top right here, you're going to see relative returns. And it's been a one-way train largely for global equity. You can see it's given 146%. SA property operating in a very difficult environment, a low growth environment with high interest rates, has struggled. There's also been a lack of confidence in the SA listed property sector. Just to emphasize, that's the listed property sector. So companies such as Growthpoint, and Fortress, and a few others. But it's fair to say that residential property, with the exception of perhaps the Western Cape, residential property has also struggled for very similar reasons: low growth, difficult environment as far as services being provided and the like. But we do believe that there's been a corner turned on that. Another one to look at is rand weakness, because this is always a wonderful news item to talk about how weak the rand is, or how much it weakened over the last month or quarter or year, or even the last 20 years. I'd be very, very cautious to make portfolio decisions based on that. And one of the reasons for that is that if I talk about how the rand has weakened over the last 5.5 years, that minus 21% looks particularly bad. But structurally and fundamentally, in the way that markets are supposed to work versus the US dollar, South Africa has a higher inflation rate, and our currency is structurally supposed to weaken over time. And in fact, if I go and do the calculations over this time, that minus 21% is not out of the norm. You expect it to weaken over time, but you mustn't forget that that weakness translates into asset returns, asset class returns. Our bonds factor this in. They consider the fact that the rand is going to weaken over time. SA property, SA equity, all of those are factoring that in. And that's part of the reason why you can't just sit in cash. You actually have to move out into I guess, the world of slightly riskier asset classes. That helps you to generate returns. It helps you to protect your portfolio from things such as inflation. It is quite important to be aware that although the rand weakens, it doesn't mean that you can't benefit from that. If I turn our attention to global asset class performance, but look at it in US dollars. So now let's imagine we've taken money offshore. We're not looking at it through rands anymore. We can see a similar thing to what I was showing you in the other slide, in that it's been a one-way train for North American equities, outperforming in a similar way, very similar reasons and drivers. And in fact, it's North American equities that's gone and driven that global equity return that I was showing you earlier. And if I take another drill down step into North American equities, it is in fact a very narrow part of the market, the North American equity market, that's driven these returns. You would have heard of the Magnificent Seven. You'd know them such as Apple, Google, Microsoft, all of those companies who are really a success story in and of themselves. I'm not saying it's a bubble at all. And I'll show you a little bit on valuations just so we can get our heads around that. But we've seen very concentrated parts of the market perform very nicely. That's great if all your portfolio was invested in that very concentrated part. But I'm going to also show some slides as to why you shouldn't fall into this allure of thematic investing or very concentrated investing. When you concentrate your money into a single investment or a single company, or a single sector, or a single country, you run a lot of risk around that single allocation. It is important to remain diversified. And what this slide shows you is that you've actually paid a price to be diversified. Sovereign bonds, or like if you think of bonds and equities in a portfolio, sovereign bonds, which is supposed to be the global risk-free, have given you minus 11% over the last 5.5 years in dollars. SA bonds, in fact, have outperformed sovereign bonds if you look at it through rands. So you need to look at the price you're paying for something, but also be aware that you need to diversify your portfolio. You can't concentrate those risks in a single place. And I'm going to explain a little bit later in this presentation how we manage these risks and yet still try and keep up with market returns when you have very concentrated return drivers in the market. One more lens to look at it, or another angle or contrast, is let's hang on to that North American equity performance. It's been exceptional, but in fact, North American equity is a standout or the exception. Emerging markets have lagged. They have not done exceptionally well. This would have the likes of China, India, Taiwan to a certain respect, South Korea. You've got a lot of interesting stories in there, certainly ones that would have hit headlines over the time that I'm looking at here. They would have been a market darling at one point, just as China was, and then fallen out of favor and been called uninvestable. But of course, when the one then is treated that way, suddenly you find a new market darling. At the moment, that would be India. Emerging markets are not easy to invest in. But it doesn't mean that you can't generate good returns out of that space. What you need to be careful of is the market narrative that builds up and creates these nice stories. Because when you're hearing about it, it's usually because the returns have already come. And I've got a nice slide to show that. So that leads me into this idea of everything that's going on in the market. And clearly, I've not listed it all here, but I've tried to capture a lot of the themes that have taken place over the last couple of months. But it's important to say that this is very much noise. If we focused on everything there, you really start chasing your tail. So I think it's important to just emphasize a couple of these things, talk about a couple of these things in the market, because if you fall back on a general 80-20 principle, you're going to say 80% of these things, or sorry, rather 20% of these headlines are really going to be driving 80% of the signal in the market, the important part of the ups and downs in your different asset classes. And it's important to know that the cornerstone for investing, the global risk-free being the treasury market, has seen an increased volatility, and there are a number of reasons for that. But I think that will settle. We've seen it settle certainly in July. So it'll come down. Market will become less jittery about what's happening in that space. The US Fed was talking last night, and that would have brought treasury volatility down even further, the expectation of future interest rates in the US. And of course, South Africa's Reserve Bank is very, very aware of what's going on there. In order to manage our currency, we can't just operate in a vacuum. That's not something that our Reserve Bank can do. It's not something our economy does at all. We need to be very cognizant of what's happening globally. But In short, what this means for you, and what that meeting last night was about, is that we should start to see South African interest rates come down. That's if you have a home loan, those payments will begin to come down, a car loan similarly. But we also might start to see interest rates coming down from an investment perspective. That's good if you're currently holding bonds. But if you're drawing in income, you need to make sure that the portfolio is constructed in the correct way, not overly conservative, equally not just taking on risk for the sake of it. We believe that we do find that optimal level of risk versus return in our portfolios. We've seen the Magnificent Seven, those big US tech businesses, just getting bigger and bigger and bigger. But there are reasonable valuations if you look outside of that, when you're looking at other countries in developed or EM or emerging markets. But even in the US, you've got parts of the market that are cheaper than everyone will be talking about how expensive US equities are. I've got a nice slide which actually it's a little bit of fact to that and says that they're not that expensive, maybe slightly on the expensive side, but not significantly so. Inflation is coming down. That's great news. And I mean specifically in the US, but also in South Africa. South African elections seem to, in a way, have been an age ago, but that's material for our South African asset classes and the rand and South African bonds, and equally the way that we experience with the environment around us. It's not just markets that matter. And whilst that's what I'm talking about, it is important to realize that we experience the world outside of just markets as well. And then that looming US election, which is certainly going to grab headlines for the next couple of months. I'll have a couple of technical charts that I'll show you along the way. So again, please feel free if I use a term that doesn't make sense, or perhaps if you actually even disagree with my opinion on something, I'd really encourage you to post some questions. Then during the Q&A, I'll jump back to the slide. We can talk about it, even debate around it a little bit, or yeah, perhaps I've even misstated something and I can correct myself. But I do encourage you to please have some questions there. What I'm showing you here is not too complicated. So let me just first talk about this x-axis, starting yield. That's effectively the interest rate that you get. It's what the market is saying, we need this interest rate to go and support governments, go and buy their bonds, and allow them to then take that money and go do something with it. It's similar to when you want to buy a home loan, except you're on the other side, and the bank comes and tells you this is the interest rate you're going to pay. They've sat and done a very similar calculation to us, and they said, this is the interest rate that you're going to pay, this is the return that we're going to get off of that. That's the bank's perspective. When you invest in global government bonds or South African government bonds with your investment portfolio, you're essentially saying, PortfolioMetrix, please go and say, what interest rate should I be getting for these instruments? Right? And then this is one of the ways that we go about doing that. And we will look at the interest rate, we'll look at where the market is and say, well, return out of that investment, and then go on your behalf and make that investment. So what you can see here is ultimately the higher the interest rate that you buy a bond at, the better your return over time. But what you can also see is a lot of colors here. So in the 2010s, when interest rates were very, very low following the GFC, you entered at a low yield, you got a very low interest rate for your investment, and of course, you got a very low return off of that. That's the reality. But what we're seeing at the moment is that interest rates have moved up significantly, which means that you can buy bonds and get a much better interest rate off of it, which indicates a much better forward-looking return. And you can see how tight that relationship is here with this line. So it's important to say that whilst in the past you've not been rewarded or you've paid a price to be diversified, this idea of diversification is starting to look more and more interesting as we move forward. It's another technical chart, but I'm going to explain it now, and then I'll explain some of these details again just now. But what I'm going to show you here is a forward price earnings multiple. It's a way to value the market. So when you read a news headline or a bit of research that says that the market has hit an all-time high, and then suddenly you think, oh, geez, I should sell because it's higher than it's ever been, don't feel that way. The all-time high is really an indexed price return. It moves up. It's supposed to increase over time. If there was no volatility or risk in the system, earnings should be growing consistently over time. And equally, that all-time high, you should be getting a new all-time high every single day. Every single day that the market is open, it should tick up just a little bit higher. Right? But that doesn't happen because earnings fluctuate, the market's perception or view on those earnings fluctuates. And ultimately, it's this idea of sentiment or optimism, pessimism around the market that goes and drives those PE multiples. It is a good way to gauge the sentiment in the market. So what I show you here, these blue bars represent the PE multiple in different parts of the global equity market. Over here, I have the US and some very specific sectors. So I have the S&P 500, very, very well-known US equity index. It's the large companies in US equity. Then I have information technology. So just a specific sector of the S&P 500. Now, this is where you're going to find all those big tech names. You're going to find them operating in this space, and they're a large portion of this index. So you can see all the optimism around the US is much higher than the rest of the world here. And equally, the optimism in the information technology sector is a lot higher than the broader part of the US market. Growth versus value, again, you're going to find very tech-orientated names here, whereas here you might find some more oil companies, financial companies, utilities, and the like, the more consistent businesses that are not looking to grow their earnings significantly. Whereas these ones are very much priced on, well, what are they going to deliver in the future? But what you can see from this red dot to the right here is that developed markets, excluding the US, and emerging markets trade on a much lower PE multiple. They are far less expensive. But what I'm saying there is actually incorrect, right? Because what you need to do is say, how has South Africa, as an example, traded in the past? And that's that green dot. That's the average PE for as long as we have data for. So it's roughly about 20 to 30 years, depending on which index. And then you go and look at where are we at the moment, and then you can say, fine, the average is higher, so we're cheaper than the history, all right, just a little bit lower. So South African equities are a bit cheaper than they have been in the past. And I'd argue for good reason, all right? Brazil, similar. Emerging markets in general, not too cheap. But here you can see, if I come back to this very tech-orientated sector, the blue bar is above the average. It's trading more expensive than it has in the past. But there's some statistics that we can apply to it and say this is actually a fair value range. It should be trading in here. It's not a significant signal if the blue bar is somewhere between these black lines. So in the US, you can see that markets are only just a little bit expensive, but in emerging markets, they're just a little bit cheap. But that is not a signal strong enough to go and tilt things. And the reason that I'm presenting this to you is that you'll read a lot of articles or hear a lot of people talk about how expensive the US is. This shows us that it's a little bit expensive, but not extremely expensive. One other measure to consider, and one of the important influences on the market, and has been since 2021, 2022, is inflation, and especially US inflation. I was on a call this morning on some macroeconomic data that's come out, and looking at US inflation, if you exclude residential contribution to it, it's at the target that the Fed is looking for it to be at. The central bank wants inflation to be low and controlled within a certain space, and that allows them to bring down the policy rates. The Reserve Bank wants our inflation to be at 4.5%. If that happens, they can bring down our interest rates. Then you see that play through into the economy because money is easier to borrow or cheaper to borrow. If you want a home loan, suddenly your interest rate is lower. You've got more money to spend. Perhaps you spend it in the real economy, and then we start to see some good economic growth coming out of that. Of course, high interest rates have the opposite effect because now suddenly you feel like you have less money because your home loan costs more, your car loan costs more. And so you're spending less in the real economy. And so you start to see some economic contraction. And I think it's very important to understand that they refer to it as the wealth effect or the reverse wealth effect. And that's how central banks try and influence what's going on in the market. That's how they try and influence inflation and keep it at a steady ticking pace. The Fed does not want to see inflation at levels like this. In South Africa, this is what we have. We're just here at about 5% as an example. We're used to inflation. We should structurally have inflation as a developing country, but our Reserve Bank wants it to be at 4.5%. The Fed wants theirs to be at 2.5%, 2%, much lower than what we experience. Of course, I've spoken about it before and more broadly in other write-ups that we've put together as PortfolioMetrix, but it's a year of elections. Half the world basically has gone or is going to the polls in 2024. And it's very important because outcome for the political sphere is not always a good outcome for markets. So markets get jittery around this time because they say, have we priced in the risk? And you can see that in South Africa as an example, where everyone was concerned that the MK, the EFF, or the ANC was going to have an outcome from not market friendly, right? Why this matters is especially around the US. But once again, there's a lot of research which says don't move your portfolio around because of elections. Don't think that you can reprice or make it more conservative. And I think that's very important because I think if we go all the way back to the EU referendum and more specifically the results that markets had there when the UK or Britain voted to exit the European Union, what happened there is consensus was we don't know what's going to happen. You need to go into cash and protect your portfolio. And a lot of investors did that. We even saw that with a few of our investors. Or rather the portfolios that we manage. And we didn't change that, but investors required, or advisors in some respects said we need to reduce exposure. You need to be careful of doing that because what actually happened is that the pound weakened versus the rest of the world. And so you saw a negative return on your supposed conservative investment. Whereas if you'd stayed in UK equities or global equities, you would have had a much better support and mitigation of the risk in your portfolio. I did say I'd come back to the US and the valuations and talk about these. I've got 3 specific sections here. And what this chart shows is that PE multiple through time. When it goes up, the market is getting very optimistic about what's going to play out. When it goes down, very often it's coming to a fairer level, but sometimes very, very pessimistic. And then once again, you can see more recently, we've had a lot of optimism in the market. So that's essentially what I'm showing you here. It's how optimistic or pessimistic the market is around the earnings stream, the forecast earnings stream. And if we go and look at exactly what that is, you can see the top 10 in the US market, so the big tech names essentially, are trading about 40 to 50% more expensive than they have versus their own history. The other 490 stocks are only at about 10% more expensive, and that's not a strong or significant signal. So if somebody says that the US market is expensive, there are portions that are expensive, but perhaps they can grow their earnings and bring that back down to a more reasonable level. I want to take a look at South Africa quickly, and again, I encourage you, any questions or queries or anything related to your portfolio, please post in the Q&A. But if we talk about South Africa now, so bring it a lot closer to home, specifically the election and I suppose the longer term history that we've experienced over time, I do want to talk about the negative sentiment in South Africa. I can assure you that in some respects you've earned good rewards for it as an investor, but there has been a negative sentiment, and this is the Rand, the Rand-dollar exchange rate. Starting in 2012, you can see we're below 10. Let's call this about 8.5 Rand to the dollar. You can see how it's moved all the way through here, where we've touched nearly 20 Rand to the dollar, and then sort of hovered around at these weaker levels, particularly since this COVID blowout came down here, and then again came to a actually weaker point in Hong Kong. And this is important because the Rand has weakened a lot. But be cautious of the person who goes and talks about how much the Rand has weakened and how they were right about it, because you can still earn good rewards in South Africa through South African asset classes by maintaining exposure to these asset classes. Something that we watch a lot more closely and in some respects is more important is the South African yield, government bond yield. This is the interest rate the South African government pays on their debt. When they issue debt or go and raise debt in the market, this is the interest rate. And you can see how it's followed the rand. It's been a negative sentiment as well. I'm going to overlay a couple of events here, most of which are negative. A lot of them are global and not only local events that have occurred. But what we have seen is a lot of these things, such as Nenegate and state capture revelations, the rally or the recovery in these through Ramaphoria, and then of course COVID coming along, and then a lot of the inflationary issues, and only one or two domestic issues here. A lot of the weakness that we've seen over the last 2 or 3 years has been global events rather than South Africa. Yes, there's the Lady Russia Gate, and yes, there's Pala here. But in order to re-rate a lot of this, we need the Fed to bring interest rates down, and that's what I've spoken about, and that's what we're most likely going to see moving forward. Equally, we need to see structural reforms in South Africa, and that's what I'm referring to here as a new dawn, where we've seen coalition government form in South Africa. And it does offer a lot of promise and possibly introduces turning of the corner, a corner in South Africa and the way that the rest of the world views us and prices South African risk. So there's your negative sentiment. It's been a one-way bet in a lot of respects. It's been easy for people to bash South Africa, but I would like to say that there's a lot of resilience that we've demonstrated through this time period. Our market has not fallen apart. We did not go the way of Zimbabwe when Nenegate happened, when all the revelations of state capture came out here. Let's remember that they were actually taking place here and people weren't aware of it, not to a full extent. When the world shut down through COVID, again, South Africa recovered and continued. So anyone who says that South Africa is just going to fall apart, I think it's a little bit extreme. We are a very, very resilient economy, country, and group of people. But for your portfolios, the question that we need to ask is, are we going to see a continuation of this trend? That's not to say that things don't grow to the sky forever and they don't turn to zero very often. So continuation of this trend needs to break at some point. And I think that we've quite possibly identified a good turning point now. We aren't going to position portfolios for these turning points. We're trying to build a portfolio that can navigate any one of these outcomes that the market presents. And I'll show some nice stuff towards the end on that. Looking at the MK effect, this was very important, but it also presented a nice opportunity in the market. Everyone panicked. The government bond yield moved up, so the essentially interest rate that the government would need to pay moved up. It's an indication of the risk that both South African and global investors placed on the South African government, saying we're going to add this additional political risk premium into the system. But markets get a bit too excited sometimes, and within the space of a couple of weeks, you saw one leg down and then you saw another leg down. And this wasn't, at least up to this point, this was in the lead up to the election. So you can see that there was a rally without any certainty. So what that says to me is that the market overdid it. They oversold the position, put in too much premium into South African bonds. And that needed to unwind a little bit. And then, of course, we had this coalition government. We saw another unwind of the risk that had been placed into the system. It speaks to some of the irrationality that markets sometimes act with. And why it was a bit irrational is that at the time, the best outcome that we've experienced, by the way, was not the base case. In fact, everyone was concerned that the ANC was going to get below 50%. If we reflect on it now, we say that's actually a good outcome. And I don't mean this from any political alliance or anything. I mean from the way that government is now structured, it's very important. And in fact, then markets were concerned, saying, well, we want the ANC to be between 45 and 50%. That's a good outcome for us. And it turned out the ANC was a lot lower at 40%. It also turns out that MK came from nothing up to 14.5%. Ironically, the best showing in the elections on a number of different ways to measure it, yet they were the ones saying that this election had been rigged and stolen from them. The ANC were the ones who were probably best positioned to say something like that. And yet we didn't have that. Instead, we had a free and fair election We had Cyril Ramaphosa in some ways building on his, or potentially building on his legacy, and marking an important point in South African history where power had been freely handed over in some respects. Yes, the ANC is still a very, very big part of government, but they are not the majority party. There is no majority party anymore. It now requires compromise and ultimately government of national unity in order to pass budgets, in order to provide oversight in Parliament. And I think what we're going to see is a lot more results out of our government. One small thing that I think was not identified, though, and it's very, very important to point out, is the restructure of ministries, but more importantly, state-owned enterprises now report effectively directly into the Ministry of the Presidency. And that's important because that's what's been stifling the growth in South Africa. Yes, there's been corruption, there's been a lot of other aspects, but growth has been stifled through Eskom, through concerns around water and infrastructure and roads and our rail networks. And those now report directly into the ministry, and more particularly into Operation Vulindlela in a way. And they've been very effective in bringing some results about. What we've seen in that rally I was showing you earlier is the difference between South African and global asset classes. These are the listed asset classes again. So when you see property, don't think of the house that you're in. Think more of large residential projects by listed companies. Think of logistics businesses or warehousing and the like, as well as office parks, shopping centers, things like that. It's all listed companies. And you can see that the green bars significantly outperformed the red bars. Now, if we had built a portfolio following that negative sentiment on South Africa and said, listen, we're worried about the elections, we're going to overload the portfolio with global equity, it's the only way to protect your portfolio, we would look a little bit silly right now, because you saw an immediate strength in the rand. You saw South African equity, South African property and bonds perform exceptionally well and outperform their peers. And so it's important to not tilt your portfolio too strongly one way or the other. And that's the way, or our philosophy, that's the way that we build portfolios, that's our approach. And I'll talk a little bit more about that. But just one last little thing is, it's easy to say, oh yes, South Africa and emerging markets were in a favorable position during this time. It's not. This was a very specific South African event. And you can see how Brazil, one of our closest EM peers, actually weakened over the time. That's the red line or terracotta line in the background, whereas our bond yields or interest rate that government needs to pay came down during this time period. And it might not seem like a lot of change here, but I can assure you that is a significant change in our government bond. And this is not Ramaphosa 2.0. The market got a little bit too excited with itself in 2017, 2018. They had re-rated asset classes so significantly that it was priced for the best potential outcome of earnings coming through really quickly and the like. That didn't happen. And then our equity market sold off, our bonds sold off. And then, of course, a couple of global events occurred as well, which weakened them further. But what we see now is that there are structural reforms taking grip in our economy. Electricity is certainly a tangible experience that we've had. Digital communication is important. Water is very, very important, and perhaps to a degree flying under the radar. Operation Vulindlela, which is let me just say, it's a very special project management team sitting in the Ministry of the Presidency, perhaps serving functions that ministers and ministries should already serve. But nonetheless, we're seeing good positive outcomes coming from here. They're very transparent in their reporting and what they're doing. You can go online and find these reports and see what they've done and what their objectives are. But we're addressing water, we're addressing transport, which is important, and of course, electricity and digital communications. Let's touch on electricity quickly and say, well, what happens when government steps out of the way or enables corporate South Africa to take effect? This is Medupi Power Station. I do believe it's a little bit further in its construction than this picture suggests, but what I want to say is that the moment licensing threshold, just some policy reform took place at the end of 2022, the public-private partnerships, corporate South Africa, as well as private, I suppose, households, installed 4.5 gigawatts of solar power. That was just government getting out of the way and enabling people to spend money. It's not government spending any money. This was corporate and private households spending money. That 4.5 gigawatts, which came online in a single calendar year, is equivalent to the Medupi power station, which took government 17 years to bring online, and arguably is still a difficult headache as far as ongoing maintenance goes. So this is the type of outcome that you can get when government steps out of the way, when they enable the private sector to do a lot more in the economy. We have a very low base in South Africa, as in sentiment is very negative, investment is very low, all of that. We just need a couple of things to turn our way, a couple of policy reforms, a couple of initiatives as far as addressing weak things in South Africa, and we'll see other examples of this in not too long going. If I look at a global perspective again, just as I move towards portfolios, I want to re-emphasize this idea that it's not just South Africa who's struggled as far as returns go. Emerging markets, the UK, Europe excluding the UK, Japan, Australia, all of these regions, Japan included, because it's quite important to recognize them. They operate slightly differently to the rest of the global equity regions. They've struggled. This global equity performance that everyone talks about has been very narrow in the US, and the US is a large portion of it. So it is important to be sensitive to trends and whether they continue to go forever, which I think we can recognize as not likely. This gap here cannot continue to get wider and wider, otherwise we'll be left with only North American equities and nothing else. But can it continue for a little while longer? It certainly can. But what I want to caution against is this idea of herding. Because US equities have done well, and because US tech has done so well over the last, let's call it 10 years, people take comfort in extrapolating that and saying this is the trend that's going to continue. Just like South Africa, which has done so badly for so long from a perspective or perception basis, it's the same thing. South Africa will continue to do badly. And I'd like to say you need to be careful about extrapolating on that, and even more careful about building a portfolio around that. The way that we build portfolios is very much on asset allocation, portfolio construction, and measuring and observing risk, and building a portfolio that's balanced on a risk basis. The way a lot of the industry builds portfolios is looking at stocks and getting excited about how Standard Bank is going to outperform FirstRand, or on a global scene, how Apple is a better business than, say, Google, and they list all their reasons for it, and never ever really close that loop except in instances where they were right. I don't think you have many global or local managers who will say, this is where we got it wrong, this is the impact it had on the portfolio, and this is why we got it wrong. I think very often, if you get an acknowledgement along those lines, it's so often the market is actually wrong, not us, we were right, but this and this and this happened. Here's an example of how investors are often lured into thematic investing because it feels tangible. If I talk to you about a new ETF that I'm going to launch, which is focusing on the Magnificent Seven, usually the reason that I go and do something like that is because the returns have looked like time. They've rallied significantly, they're strong, and now I can show you a fact sheet where I've outperformed global equities by 10 or 20% per year. But this, in the background, is not just an illustration. This is an actual study, a research paper. We'll share the presentation. You can go and look for this research paper if you like. It was done a year or two ago, but this is the return that follows the launch of these products, these very thematic investment products. And you can see how it's because it's topical at that point, yet those return drivers that gave you everything on the way up very often fade, and cycles of the market start to turn, and then you see that you actually have negative or bad returns. Similar with sector. So if I was talking about a fourth industrial revolution type fund, or like ARC ETF, this is the type of thing that plays out. And I can show you a lot of stuff that we've done which mimics or represents this. Similarly with sector, where I say I'm going to give you, I think there's the ETF QQQ, which is a very tech themed ETF. Whereas if you go and look at passive, because I'm not bashing passive at all, these two panels at the top here are very much talking about passive, you can see how it's very, very narrow and in line with the index. It's not giving you a bad outcome here, very negative excess return. This is very negative excess return. Similarly is that. So our process, and I'm showing you one or two complicated things here. If you recognize it, then that's great. You've done a lot of work and research into portfolio theory, but asset allocation and implementation are very, very important. But what this speaks to is how we manage risk and how we look to navigate an uncertain world ahead of us. So this is perhaps a better way to look at it and say, perhaps it's a little bit of overkill, but this type of vehicle would very comfortably be able to drive on the roads in, let's say, in Johannesburg with potholes, but perhaps in the Western Cape where arguably they're very, very few. So this car would be able to perform equally through both of those environments. But then, of course, we know that markets get a lot more volatile than that. And there's this idea of unknown terrain and very, very bumpy roads ahead. Once again, this is the vehicle that can go through that. So this is the type of portfolio we try to build. One that's aware of the risks, it's aware of different outcomes, and will perform regardless. I'm going to move through this a little bit quicker, but all I want to demonstrate here is that we are monitoring and managing this portfolio. We aren't reporting on absolutely everything every second of the day because we're not making changes like that. But we do have a lot of periods where we rebalance portfolios. You can see these white lines here during COVID where we did quite a number of rebalances. And then these numbered diamonds here speak to actual changes of underlying fund managers through time for these different colored asset classes here. If I go and talk about it specifically for global equity, you can see how we've made changes. And the importance here is to understand that we do manage your portfolio, but we're doing it through a very focused risk lens. We're not changing it because we think Magnificent Seven is too expensive or that it can continue on forever. We're doing it through a risk lens, a very balanced risk approach. And equally, we're looking for some very smart managers who can actually manage that through time, whether it's exposure to China A securities or different ways of implementing US equity. We are applying our minds to this and really what we believe we deliver value through is asset allocation, managing risk and portfolio construction. So just going through the last couple of slides that I have here, you can see our SA equity implementation. Blue is the benchmark. Black is the return we've provided. You can see it's quite a bit higher. We've been able to do this consistently over time without taking on significantly more risk. Portfolios from the multi-asset perspective, so we have exposure to a lot of different asset classes, have done well, even though sometimes these different asset classes perform disappointingly at times. But I quickly want to touch on our expected returns going forward because we need those in order to construct a portfolio. I'll refer to this as a base case. But as you'd expect, and just to simplify it, your bonds and your cash are going to give you slightly lower returns. Your equity, your riskier global property, as an example, is going to give you a much higher return, but we know it comes with a bit more risk. So how do we blend these all together to try and build a portfolio that doesn't shake you out of it, that doesn't make you uncomfortable? When you're going over those bumps in the road, you want to still feel quite comfortable or have a smooth ride. How do we blend those together? Once back to our asset allocation, optimization of portfolios. But we've gone another step and said, how could these portfolios potentially perform into the future? So based on our existing expectations, we've got different scenarios, and I've taken a number of different peer groups. Sorry, I actually haven't done any of this work. I'm presenting it to you. We've got some very strong modeling capabilities in our team. I was fortunate enough not to be doing that this time around. But what we have here is expected forward-looking returns, and it is just scenarios. It's not real returns. It's if these asset classes do this and the fund is positioned the way they were at the end of March, this is the way that we'd expect this fund to perform. And we've got the likes of Alan Gray balanced in here, M&G, formerly Prudential, PSG, Signia. We've got a lot of different things in here, all the big funds in the industry. And these return dots here all represent where the return would be expected. This blue dot is our portfolio. And the important thing is to look at where we perform relative to these other dots as I present different scenarios. So if we have our base case, you can see we perform right at the top of the group because, of course, we've built a portfolio that's very, very efficient. We're managing that risk, and we're really extracting every bit of return we can for every unit of risk we've taken. And then that's the range of portfolio returns. And I'm going to ask you to every now and then cast your eye to the right here in a portfolio that's typically a lot more active in how they're positioned, but very different from peers. What happens if SA equity underperforms though? So we don't see the returns that we expected when we built a portfolio. In fact, it's a different reality. It's almost guaranteed that that's going to happen. It will be different from our expectations. But you have global perform in line with our expectations, SA equity underperform. And this is representative of what we've seen over the last 10, 12 years. Well, in that instance, our portfolio still does well. You've got this right-hand dot over here drawing out the range on the upper side. They're clearly positioned for global equity to do well. But here you can see we've done very well relative to peers once again. So your portfolio is well positioned for an event that goes against us, so to speak. If we look at it where SA equity does really, really well and outperforms, so this would be an event such as structural reforms in South Africa, really good economic growth, and the like. Well, what happens then? Because we did relatively well when South Africa equity underperformed. Similarly, we'll do very, very well relative to peers and absolute returns once again. And this is the asset allocation and risk control and optimization we have in our portfolios. That means we don't have to take very strong views. I'd like to point out that this portfolio, once again, is actually quite a lot lower and far out of the range that I'm showing you here. And then just coming up to the end to try and wrap up on this, what happens if global equity underperforms? Is equity performs in line? Well, once again, I think that we do quite well in that space versus peers and on an absolute basis. And then, well, what happens if global equity just keeps going like it has over the last number of years? There we go. We've done quite well again. And this is what we talk about, a very well-balanced portfolio, well-structured portfolio, one that is optimizing on risk and not just these wonderful forecasts and returns we think might happen. And it comes back to this idea of building something that can cover all sorts of different terrain, because we actually don't know what the future holds. And that's not something you'll hear many investment managers say about their portfolios. Instead, we prefer to build a portfolio that can navigate that unknown moving forward. So I think I finished just a minute or two later than I had hoped to, but I'm just going to stop sharing, and then perhaps we can go through a couple of questions related to the presentation or just in general. So feel free to speak up if you want to ask a question. Yeah. Let's go there. I do see Don is asking about megawatts versus gigawatts. So it was 4.5 gigawatts. I'll go check the slide just to make sure it hadn't stood out to me in the past. But 4,500 megawatts, 4.5 gigawatts. I may have misspoken there in any case. But let's talk about it as 4.5 stages of load shedding. Yeah.
How's it, Liam? Sorry, man. Just not seeing any questions here, but maybe something from my side that hit there when you were presenting. I think we kind of know the scenarios that we need for South Africa to really kind of have a good positive outturn. But it kind of hit my mind now when you said, well, if global equity underperforms, these are the potential outcomes. But maybe, within that study, what are some of those kind of levers or those triggers where you would see global equity underperformance, bearing in mind it's been so heavily driven by a handful of key stocks in the States, and versus the world being such a big place? I mean, what are some of the key elements in that scenario?
Yeah, so look, one of the major factors is I'm looking at that as a Rand-based investor. So if the Rand strengthens by 20%, that'll be good for SA bonds. It'll be good for SA equities. It's really going to drive those because we have a really rosy South African picture. But just the currency translation, maybe we have an ordinary global environment, nothing exciting, but the currency translation will take about 20% away from global equities. We can, of course, have the flip side where global equity really outperforms and South Africa is not looking so good and local asset classes underperform. But relative return is the big one, but Rand is a big factor in that. We don't try and forecast the Rand, but also emphasize that as Rand-based investors, we're very fortunate because we have this Rand translation, which is a great diversifier. It really allows you to build a well-diversified portfolio, which speaks to why our portfolio can perform well in different environments. We've managed to balance that type of risk. I'd argue some of the other portfolios have not really balanced that rand dollar risk in their portfolio. So, and if I can add one small thing to that as well, I was talking about these just as an example, but our global portfolios are built in a very similar way. So should North America be, let's look at that as the scenario, North American equities outperform the rest of the world to continue to go that way. Will we stay in touch with it? Yes, we will. We've built the portfolios in a similar way. If North America sort of really underperforms, I'm not going to say it's because global equities are now crumbling. Let's just say it's a gradual, controlled underperformance over time. Will our portfolio still do well? Again, the argument is yes, they will. We could model that, slides of that modeling up for you if you wish, but I guess we've only got so much time, so I thought I'd use a local-based example, but it's the same story. We're looking to balance and manage the risks in the portfolio, and risks are that a trend continues or that a trend turns, or I suppose that you just go sideways from where you are. That's what we're really trying to build portfolios for.
Oh, great. I see here there's a question that's come through from Max just around the continued rise in the US government debt. Seeing that as a major long-term risk, I suppose, does it mean that we're going back to money printing, or where does that take us?
Yeah, so it's a big challenge because as the reserve currency, they are so important. The argument behind that is, in fact, that the US, even with their rising debt levels, has become more and more important. So the market is largely recognizing that. There's some people, I think, anecdotally refer to it as the dollar milkshake. So it's this idea that if the dollar is very strong, the rest of the world takes some pain. And when the dollar, well, not the dollar, but when the US has issues, then the dollar sort of remains strong and the rest of the world takes issues. So what I'd caution about, first of all, is like saying, I know the macro event that's going to play out. And in this case, US debt levels are going to rise to unsustainable levels. And then the next step to say is, I know how the market's going to respond to that, and then go and build my portfolio around it. Because if it's 50-50 on both those decisions, you've got a 25% chance of getting that right as you compound those events.
Yeah.
Again, it's just important to manage risk. Understand that the dollar and US Treasuries is very much the cornerstone of risk in global markets. To bet against that would, I suppose, be to go and buy physical gold and find a safe place to store it and keep that and hope that you're not wrong, because gold is at quite a high level. The market has recognized that already. And if you don't mind,
I was going to say, let's hope we don't get there. My daughter watches too many shows about pirates burying treasure. I don't think we want to go back to those days.
Somewhere where it's buried, so just let us know. We can go and get some. We don't need to store it now.
Yeah.
But yes, I mean, it does ultimately speak to the financial system crumbling. In which case, your investment in a gold ETF is not necessarily going to help you, because that system is not, unless you can go to the vault and somehow access it. I know I'm talking about it on an extreme, but yes. I'll just grab Max's second question there as well about, do markets trust the absence of load shedding in South Africa? I'd say no, not entirely. We've been told the story, and we've been told the story again, and we've been told the story again. When Ramaphosa was deputy president, he was in charge of fixing the problem. He didn't. But what I'd say is different now is that we have this Operation Vulindlela. We have some very structural changes that have taken place as well. So Eskom is being broken up. We've had change in that threshold licensing, so now we aren't solely reliant on Eskom to try and give us power. But if we look at what Eskom have been doing, and I'm not going to pretend to be an energy expert or a political expert or anything, but if we do go and look at what Eskom have been doing or have done, their energy availability factor is higher, and that's a difficult number for them to manipulate. If it was easy, they would have manipulated it in the past. Their best opportunity is to neglect maintenance, but that really shows up. And so you just run the machine. You don't take your car for a car service. You just keep driving until eventually it just can't be fixed. Or alternatively, you run those open gas turbine generators, which are extremely expensive. But you yourselves can go and check that data if you wish and see that Eskom is not spending money on diesel. And so they're actually not running those open gas turbines as they have in the past. Previously, they've used that as a stopgap. I think markets are aware of this. They're comfortable and they're largely accepting it, that it's like Eskom has turned a corner to an extent. as well as a couple of units of Medupi and the like coming online, which is helping. I'm not saying we won't get load shedding. I was giving a presentation the other day and the power went off halfway through just before I was at the Eskom slides. But I'm not saying that we won't get it, but I think the significance of it is a lot lower, or the impact of it is a lot lower. We're not talking about stage 8 anymore. So if you just want to take it as a gauge like that, use 24 and the like, can't even talk about that. Yeah.
Yeah, no, I think it was interesting. We had a session with the team at 91 a little while ago, and they also mentioned that, all of this maintenance that's been allegedly happening during the load shedding actually has been happening, and they reckon the load shedding schedule is on average about 2 stages lower now. Should it be reintroduced? So I think there are positive things, and we actually had a session last night, and they were talking about this sort of special unit, and the guys were specifically saying how important it is to step away from that monopoly of Eskom. In terms of power generation and supply. So yeah, look, I think it's all positive things coming through. Let's just see if they can deliver and execute on it.
Exactly. Exactly. And sorry, just to add to that, we don't need to be right about South Africa having turned a corner here. Again, it's that idea and the modeling that I'm showing you is that we've built a portfolio that will benefit from a better South Africa, but it's also going to benefit if South Africa continues on its negative sentiment and trend that we've had, because we're balancing out those risks. We're not looking at this and saying, wow, we need to buy all of the small cap South African equities we can, because they're going to benefit the most from like South Africa doing better from a policy perspective and economic growth. We maintain a balanced exposure to the market, and make sure that we just consistently deliver good relative returns over time, which ultimately gives us very, very competitive returns versus peers, peer beating returns in most instances. And that's what we believe to be a lot of the value that we add and ultimately that you reap as investors in our portfolios.
100%. I see Eric's back there now, which probably means we're out of time. But yeah, I'll hand back to him and keep quiet.
Thanks a lot. Yeah, we really appreciate your time. Yeah, and I think once again, thanks for condensing a lot of the technical things out there and giving everyone a good idea in terms of what to expect and how, and that the portfolios are in good hands and it's being managed as you've always done, very consistently and diversifying away from those big thematic themes out there. So once again, from our side, thanks for your time, and also thanks a lot for everyone for attending today. We really appreciate your time. Thanks a lot. Thank you.
Thank you, everyone. Thanks for trusting us with your investments.